Roku and Netflix are having dissimilar years in 2024. Netflix share price is up over 89%, and of course, I'm happy about that. Netflix was one of the stocks I rated as one of my top stocks to buy in 2024, and the excellent performance pleases me to be sure. Roku, meanwhile, is down over 8.9, almost 9% year to date in 2024, which is disappointing to be sure. I did have Roku stock rated as a buy, but not as one of my top stocks to buy. I ranked Netflix higher than Roku. But what about for 2025? Which one of these two streaming companies is the better buy for 2025? That's the question I'm going to answer in this video, comparing these two companies on critical financial metrics, also explaining, giving a tutorial on cash flow from operations and why it's important for investors like myself, and looking at the company's cash flow, discounted cash flow valuations to see which one is more undervalued according to that metric. So there's a lot to cover in this short video. Let's get right into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, looking at the trailing 12-month revenue comparison for Roku and Netflix, you can see the phenomenal growth Netflix has delivered at over $37 billion in revenue, up from a little over $8 billion in revenue in 2015. Roku, meanwhile, has also delivered excellent growth, up to $3.9 billion in trailing 12-month revenue. The tailwind that's facilitating growth for these two companies is the fact that it's just so much more convenient to stream your content instead of getting your content via a cable subscription or a satellite TV subscription, which are incredibly more expensive than streaming subscriptions and also incredibly more inconvenient because you can only watch them when you're at home or in your office or somewhere where you're connected to the satellite or the cable connection, whereas your streaming subscriptions you can take with you anywhere you get internet connection, which is almost everywhere nowadays. Now, I want you to understand why cash flow from operations is so important to me. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now that you've got an understanding of why cash flow from operations is a critical metric, you can see Netflix outperforming Roku in this regard. Its cash flow from operations in the last 5 years jumping from negative 15% all the way up to 20%, while Roku has also demonstrated slight improvement, although more volatile. However, looking ahead, analysts on Wall Street are very bullish on Roku's cash flow expectations, as am I. I think the company will increase its cash flows robustly over the next several years as its growth into new categories, new geographies like Canada and Mexico, and new categories like manufacturing of televisions, which will help facilitate further growth for the company's business. There are risks to be sure, but I believe Roku's cash flow will grow robustly. Similar story with the operating profit margin, Netflix demonstrating a better number at over 25% and better growth than Roku, which has been more volatile and negative 7.27%. Although in this metric as well, Roku is improving, and I expect this improvement to continue for similar reasons that I highlighted before. Now let's get into the valuation comparison for these two streaming stocks. When measuring by the price to free cash flow, Roku is more expensive at 80 compared to Netflix at 57. However, when looking at the discounted cash flow valuation models I've created, Netflix, the intrinsic value I get for Netflix stock is $826 per share, compared to its market price of $921 per share. I've used various growth rates, and if I use a 6% growth rate instead of a 5% growth rate for Netflix, that would give me an intrinsic value per share of 937, which would make the valuation more in line with the current market price. My discounted cash flow valuation for Roku suggests the intrinsic value per share is $86 compared to the current market price of $83. But when I do similar scenario analysis for Roku at a lower beta, it gives me an intrinsic value per share of $128 compared to the current intrinsic value per share of $86. All right, with all that being said and all these calculations being done, which one is the better buy for 2025? Well, it's not an easy decision because I'm bullish on each of these two heading into 2025. I have each of them rated as a buy. But if I had to pick only one of these two to buy for 2025 and beyond, I would pick Netflix. I would say Netflix has the better risk versus return for long-term investors heading into 2025 and beyond. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.